Market stress doesn't start with a crash. It starts with something quieter. Liquidity dries up, trading gets thinner, prices move more violently, and suddenly small shocks create big reactions. Liquidity is simply the ability to buy or sell without moving the price too much. In calm markets, liquidity feels unlimited. You can sell, and someone else buys. Spreads are tight. Prices move smoothly. But in stressed markets, liquidity becomes selective. Buyers step back, sellers rush forward, and the market starts behaving differently. This is why liquidity is one of the most important hidden forces in finance. Because when liquidity disappears, volatility takes its place. So how does liquidity dry up? It usually happens in layers. The first layer is risk appetite. When investors become uncertain about inflation, rates, geopolitics, or growth, they reduce exposure. They move into cash, they rotate into safe assets. They stop taking marginal risk. That reduces the number of active buyers in the market, and fewer buyers means less liquidity. The second layer is funding costs. Funding costs matter because they determine how much leverage the system can carry. When money is cheap, investors borrow more, hold larger positions, and market makers can provide deeper liquidity. When money is expensive, the opposite happens. Leverage gets reduced, positions get smaller, market making becomes cautious, and the system becomes less able to absorb shocks. This is why rate environments change market behavior. High rates don't just slow the economy. They reduce risk capacity across portfolios. And when risk capacity falls, liquidity becomes fragile. That fragility is what turns normal volatility into disorderly moves. When interest rates are high or funding markets tighten, leverage becomes expensive. Hedge funds reduce positions. Market makers reduce inventory. Banks become more cautious. This matters because modern markets rely heavily on intermediaries who provide liquidity. When those intermediaries pull back, spreads widen quickly. The third layer is forced selling. This is where market stress turns into a feedback loop. If prices fall, some investors must sell. Margin calls force liquidation. Risk models trigger de-risking. Funds meet redemptions. And when selling becomes forced, it doesn't wait for good prices. It sells at whatever bids exist. That pushes prices lower. Lower prices trigger more selling. And suddenly the market isn't discovering value, it's discovering urgency. This is why stressed markets can overshoot. Not because fundamentals changed overnight, but because liquidity vanished. Now you can often see liquidity stress before it becomes obvious. Here are the warning signals. First, credit spreads. When corporate bond spreads widen, it signals rising risk premiums. Markets are demanding more compensation to lend. That often shows up before equities collapse. Second, bid-ask spreads widening. If spreads widen across assets, it's a direct sign liquidity is thinning. Third, volume changes. In stress, volume can spike during sell-offs, but buying volume often disappears. Fourth, correlations rising. When liquidity dries up, everything starts moving together. Good assets get sold with bad assets. Investors raise cash by selling what they can, not what they want. That's why diversification can fail during liquidity events. There's also a macro trigger layer. Liquidity often tightens when central banks are restrictive. If rates stay high, cash becomes attractive. If quantitative tightening reduces liquidity in the system, risk assets lose support. Even without a crisis headline, financial conditions can quietly tighten. And when financial conditions tighten, liquidity becomes fragile. Geopolitical shocks can accelerate this. Energy spikes can shift inflation expectations. Currency moves can trigger outflows. Debt stress can hit emerging markets. All of these can move capital into safety and away from risk. Liquidity is the channel through which stress spreads. So what does this mean practically? It means the biggest market moves often happen when buyers step back, sellers rush forward, and intermediaries reduce risk. That combination creates air pockets, and air pockets create abrupt price moves. The key is that liquidity stress is non-linear. It can look stable for weeks, and then break in days. That's why liquidity watch matters. It's often the difference between a normal correction and a disorderly move. Market stress isn't just emotion, it's structure, it's funding costs, it's leverage, it's spreads, it's risk capacity. And when risk capacity shrinks, liquidity disappears. So if you want to understand the next market move, don't only watch headlines. Watch the hidden mechanics. Spreads widening, credit tightening, correlations rising, forced selling increasing. Because when liquidity dries up, markets stop behaving rationally, they behave mechanically, and mechanical markets move fast.